Welcome to another episode of Wealth Building Conference. My name is Oludare Fasola. Today is another day, and I want to wish every father's happy Father's Day out there. Uh, it's another year of to celebrate ourselves. I want to celebrate every father out there. Thank you for joining. Once again, this is another today's another episode for medical professionals. We use today to celebrate medical professionals. If you are a medical professionals and you are a father, I want you to celebrate yourself. Please celebrate yourself as you are joining the program today. Wherever you are joining, I want you to please type your name and where you are joining from. If you are joining from Canada, just type your name and write Canada. If you are joining from any other part of country, please any outside Canada, please make sure you type your name and write where you are joining from. Again, please share this link with friends, families, whoever you think that might be interested in learning about financial success for medical professionals. Please share this link with them. Of course, medical professionals, they have a different peculiar their situations is like it's peculiar because of they are actually classified as high income earners. But if you want to learn about finance, if you want to learn about how money works, this is also for you, right? Share this link with friends, share this link with families. Please don't be selfish. It's a free event. Please make sure you share this with other people that you feel that they might be interested in learning about financial success. Once again, you are welcome. Today, we're going to be diving into another important area, which is how medical professionals can strategically plan for their life in a tax-free environment. Everybody type tax-free environment, tax-free environment. If you are saving money or you are earning money and you don't know how to multiply your money, especially grow it in such a way that you are not going to be paying as much like crazy tax, it is very key and important to know how you can grow your money tax free. But before we go into that, I just want to be, let you know that we're going to have like a 3-day challenge for fathers. Okay, starting from tomorrow, we want to share that information on how fathers can actually plan for their life, how fathers can live a debt-free life, how fathers can save money towards emergency funds, how fathers can plan for their retirement, how fathers can plan for emergency in case of critical illness, in case of disability, because the only income you can protect is yourself, right? You are the income, you are the breadwinner of the family. Imagine if you are unable to work, right? That income, what is going to replace that income? So we need to educate ourselves on why yourself is the only important asset you can protect. All right. Please don't get knowledge, get informations. Make sure you understand how money works, because if you don't know, your money might not work hard for you. If you are working hard and your money is not working hard for you, chances that you're going to be working and you retire, you still continue to struggle. I've said it several times that higher income does not really translate to wealth, right? Everybody understand this. Please let me repeat this. Higher income does not translate to wealth, especially you as a medical professionals. If you are exchanging your time for money, right, you need to understand that it's a time will come that you will not be able to do that thing that you used to do now. Maybe by virtue of age, by the virtue of the fact that you need to retire at some point, sickness can strike at any time. Anything can happen. Life, life may take a different dimension. So we need to plan for all these unexpected. And the only way to do that is to get knowledge, get informations. Don't live on illusion. Don't feel that you knows everything. You are a medical professionals. Let financial professionals handle your finances for you. All right. I do you to tell every medical professionals I know that you are medical professionals. I am a financial doctor. So my goal is to make sure that I look after your finance, plan for your life, plan on how you can grow your money. And also, even when you pass, right, you still have something that you're going to left behind for the beneficiary, for the family. Once again, you're welcome to another episode of Wealth Building Conference. I'm super excited today. Happy Father's Day once again to all the fathers in the house. So I'm going to pull up my slide and we just quickly go into the presentation. So today, we're going to be looking at another important topic, right? Strategies to grow your wealth in a tax-free environment. Everybody type tax-free environment, strategies to grow your wealth in a tax-free environment. A roadmap for medical professionals. This is actually designed for medical professionals. But like I said, right, if you are not a medical professional, you can also apply this to your own finance as well. Because if you are business owners, if you are uh if you are high income earners, so to say, like you are IT professionals, um please, this is actually for you. But because I actually focus on medical professionals, I want to use this to educate other professionals out there on how they can grow their wealth in a tax-free environment. Everybody type tax-free environment, tax-free environment. Now, let's quickly go into them. Now, before we go into the presentations, I want to quickly make a very welcome. Now, designed for high earning medical professionals. This presentation is tailored strategies for your unique situation. Like I said, it's tailored for you as a medical professional. Two, keep more of what you earn, maximize after tax wealth. High income does not translate to wealth. Everybody, please listen to me. High income does not translate to wealth. What translates to wealth is ability to keep more of what you earn plus save a lot from taxes, right? If you are earning so much money and you don't know how to keep this money, you don't know how to keep the large chunk of your money from taxes, you might be working for money. And this is what happened to a lot of medical professionals. Think about it. You are exchanging your time for money, right? The more hours you work, the more money you make. Now, if you want to, for how long will you continue to do that? You should understand that at some point, you need to ask yourself, how do I make sure that I keep more of what I earn? 1 second. Quickly. How do you keep more of what you earn, especially from tax? And of course, number three, accelerate financial independence. Practical roadmap to follow. What are the strategies? What are the roadmap? What are the step by step to follow to accelerate your financial independence, right? Financial freedom is very important in everybody's life, especially you as a medical professional. Imagine you spend so much times in studying in the university, you come back and you still like continue to take care of people out there. But if you are taking care of people, who is actually looking after your finance, right? You need to quickly take time to look into your finance. How can you accelerate financial independence? We're going to show you the practical roadmap to follow. And I keep saying this every time that I meet any medical doctor, and you can listen to me very well. Your accountant cannot grow wealth for you. Your accountant cannot plan for your retirement for you. Your accountant cannot, give you that legacy that you need to give to your family. They can't give you that. They cannot guide you on how to do that. Of course, they can help you to prepare a clean book to, make sure that you file your tax, report it to CRA. If you have any issues with CRA, they can help you to look into that. But except maybe their financial planner or their financial advisor. If their goal is for just to look after your books, right, it is your duty to look at to plan for your life, plan for your financial independence. And of course, financial independence is very key in life. Important disclaimer: this presentation is for educational purposes only, not financial, legal, or tax advice. Your situations requires personalized analysis. So please speak with licensed advisor before implementing any strategy that I'm going to show here today. Please, if you need more guidance, if you need more advice, please book a call with me. All right. Don't take this to be a financial advice. All right. Let's go at the summary of what you're going to discuss today. Number one, faster financial independence, strategic planning, accelerate wealth. So we're going to look at the strategic way planning to accelerate wealth. Now, making money is not equal to building wealth, but there are ways in which you can plan and accelerate your wealth if you follow the roadmap we're going to share with you today. Two, knowledge gap. Many physicians unaware of opportunity. A lot of medical professionals out there does not really understand different investment strategies they can put their money that will give values to that money. They don't know. And it's not their fault. I mean, they are not financial advisors, they are not financial planners, they are not wealth advisors. Your job is totally different, but there is knowledge gap, right? So we want to show you things that you don't know, things that you are not aware of. We're going to share that with you today. And of course, tax erosion. High earners face significant tax burden. The more you earn, the more tax you pay. So we want to show you how can you balance the two. Like as you are earning more, you are not paying that much taxes as others professionals out there, right? You might be making so much money. If you don't know the legal loopholes that you can leverage on to make sure that you capitalize that to beat down your taxes, it will be very difficult for you to build wealth. The tax burden for doctors, every type tax burdens, tax burden. Now, average medical professionals pay up to 53% in taxes. Top marginal rates combine federal and provincial. Let me quickly explain something here to you. I'm not talking about taking dividend or taking salary from the corporation right now. I'm also talking about retained earnings. Now, what does that mean, right? If you make your corporations make money, right? Let's say your corporation make $500,000 in a year, and after deducting all the expenses, right, the remaining balance of, let's say, $300,000, apply the tax, corporate taxes of maybe between 12 to 13%. The remaining balance, if you reinvest that, right, that is what we call passive income. You could pay up to 53% in taxes. A lot of medical professionals, they have money in their retained earnings, but they are afraid of taking this money out. I have an answer to that. I can guide you. I can help you to do that, right? So think about this, right? 53% marginal tax rate. Everybody type 53%. That's very huge. It is very, very huge. But there is a way out of that. All right. I'm going to share that with you before we finish this presentation. So if you are making $300,000 in income, right, you could pay up to $120,000 or more. If you don't have strategies in place to mitigate the taxes, guys, tax is number one biggest destroyers of wealth. I keep saying this in all my presentations, and I will continue to say this. If you agree, say I agree. Okay, I've seen people that because of taxes, CRA garnish their account. So it is a very big deal. You need to understand how to manage your taxes. Tax complexity, personal and corporate considerations. So there are various ways. There are different tax strategies require different ways of managing them. If you have personal tax, there is a way to manage that, and corporate tax, there is a way to manage that. We need to know what are these simple strategies and the considerations for you to manage these two type of taxes. Okay, now, wealth versus income. Everybody type wealth versus income. Wealth versus income. I want these presentations to be engaging as much as possible. I want it to be more alive as possible. Please engaged as we educate ourselves. Wealth versus income. Now let's look at income focus. High earnings easily eroded. All right. Two, status driven spending and tax inefficiency. Those are income focus. But let's look at wealth focus. Wealth, if you want to build wealth, you need to keep more of what you earn. Now, I've said that earlier that high income does not equal to wealth building, right? Get that. Everybody type wealth building. It's not the same thing. You might be making $1 million in a year. It doesn't make you to be a millionaire. It is whatever you can save and grow tax-free that make you to become a millionaire, right? Asset accumulation. Everybody type asset accumulation. Now, there's what we call asset and liability. If you are keeping more of liability, you cannot build wealth, right? Asset accumulations, accelerate wealth building. Everybody listen to me again. Asset accumulation quickly accelerate wealth building. Asset in terms of real estate, land and building, furniture and fittings, stocks, bonds, different type of investment, right? Not just accumulating asset, but you must be able to diversify your asset. Now, there must be different asset classifications that you as a medical professionals, you must make sure that you spread it. And of course, you must do rebalancing every year. So it is not about acquiring more asset, right? You must understand how to rebalance this asset to make sure that what kind of portfolios am I keeping? A lot of time, people are keeping more of asset that will trigger taxes at the end of the day, right? You must be able to balance this, and you cannot do this on your own. You need to work with medical professionals that will help you. You need to work with financial professionals that will help you to accumulate more asset, of course, diversify that asset and rebalance those assets as you move on. Everybody type rebalancing. Now, every year you check out your finances. You must audit your finances, right? How do I even diversify my asset? What type of asset portfolio, asset classifications do I have? Tax protection strategies. Now, as you have those assets, okay, what are the strategies in place to protect those assets from taxes? Let me give you an instance, right? Medical doctors, if you are buying houses, right, you're buying stocks, you're buying bonds, investment of various types, especially investment that will trigger tax, like real estate. Okay, the more assets you have, the more taxes you are exposed to. If you are buying houses, if you are buying stocks, bonds, right, those type of assets attract what you call capital gain taxes. Now, if you don't keep enough strategies, if you don't have enough strategies to protect those assets, chances is that you are leaving liability behind for your family. Okay, so you must really sit down with your advisor. What type of assets do I have, right? Do I put enough strategies in place to protect those assets? Okay, everybody type tax protections. You must protect your asset. Now, let's look at the power of TFSA. Everybody type TFSA. TFSA. As of 2025, okay, the annual limit is $7,000. This type of asset, the growing contribution room each year. So every year, CRA do review this type of uh, investment. Okay, it's a vehicle. It's a vehicle for you to grow wealth. All these things that we're talking about is just a vehicle for you to grow, to accelerate your wealth, right? Growing contribution each year. So every year they do review it. Next year again, they are going to look at it. They are going to review that. $95,000 total room. Let's say if maximized since 2009. This is just like an illustration. Okay, so it's not a real case scenario. So I've said it earlier that this might not really apply to everybody. Now, 100% tax-free growth, no tax on interest, dividends, or capital gain. So in this case, everything you put here, grow tax-free. So you don't pay tax on it. It's a powerful strategy for wealth building. It's a powerful strategy to build emergency funds, because you must understand different investment vehicles and how you can use that to build wealth. Okay, everybody type TFSA, tax-free savings account. Now, using tax-free savings account strategically, select high growth assets, maximize tax-free growth potential. Now, putting money into TFSA is not enough. You need to understand, where can I invest this money, right? You need to look at different investment portfolio, different income, different investment, rate of return. I'm talking about return on investment, right? Okay, let me put that, return on investment. So, for example, those stocks that you select, okay, will determine how much return you're going to get from this investment. Now, if you don't put it in a right vehicles, if you don't save it rightly, you might not get value for your money. You realize that at the end of the day, you just put money there and the money is not growing. So you need to ask questions when you sit down with your financial advisor. What is the rate of return? Where are you even putting this money? You need to understand your client risk appetite, right? Risk tolerance, because some people, they cannot really take that much risk. So please make sure you ask questions when they are asking you to put these investment vehicles in place. Okay, avoid cash savings, low returns with tax-free space. Like I said, right, you need to know what is the rate of returns on this type of investment. Okay, and reinvest all returns. Compound growth, accelerate well. So whatever you make from the return on investment, please multiply it, add it back into that savings, into that vehicles, and continue to multiply it. It's a very quick way to grow it. Now, if, for example, you put $95,000 at 8%, in 10 years, that will probably give you about $208,000. Imagine that. That is the power of compound interest. All right. That is the power of compound interest. And bear in mind that you are not paying tax on this money because it is tax-free. So, meaning that you are investing after tax dollar. The money you put here, that it has already been taxed, so you are not going to pay tax on it again. Let's go. Registered retirement saving plan. Everybody type RRSP. RRSP. RRSP is a tax deferred tax strategies. Deferred tax strategies. Everybody type tax deferred tax strategies. Tax deductions to the immediate tax savings. So whatever you put in your RRSP, okay, you get tax savings from that. Today, if you put any amount in RRSP, you don't pay tax. So the tax deferred growth, no tax on investment returns, and tax bracket planning, strategic withdrawals in retirement, and income spontaneous withdrawals in lower tax years. So this is how it works, right? Whatever you put there, the tax will be deferred till later years. So, and more often than not, when you are withdrawing this money, the more you live, the more your tax bracket begin to come down. So chances is that when you are when you retired, your tax brackets may be lower, at least a little bit, compared to when you are actively working. All right, is a strategies for high income earner. At least whatever you put there, you save the tax today. Okay. You don't, it doesn't really matter. At least whenever you want to take out the money, you pay the tax, but at least you enjoy the money today. It's an important strategies for wealth building. So, and as a medical professional, you must have everything. Have TFSA, have registered retirement saving plan as well. You must have everything. You must have everything. Everybody type RRXP. Now, individual pension plan, IPP, individual pension plan. A lot of medical professionals don't know this. Of course, if you are doing salaries, at the end of the month, your accountant prepare your payroll, they remit some money to CRA, all right, and they also, you also remit to pension. But there are other ways in which you can also plan for pension. We have individual pension plans, right? Pension like tools for incorporated doctors, defined benefit plan structure. So this kind of a plan has a defined benefit plan, right? Greater contribution room after 40 years, exceed RRSP limit. This actually exceeds the registered retirement saving plan. So once you maximize your RRSP, you can actually use this as a backup for your retirement. Okay, everybody type backup. Now, corporate tax deduction, fully deductible contribution. So this also is another way to plan for taxes because it is tax deductible. So it's a very good way to save on taxes. Creditor protections, amazing. Asset shelter from the claims. Everybody type creditor protections, creditor protection. So this type of individual pension plan is also creditor proof, right? Meaning that if you are owing creditors, if anything happens, this will bypass creditors. So nobody can go after it. So it's another very powerful strategies to build wealth and to plan for retirement. Every type IPP, individual pension plans, individual pension plans. Now, let's go to permanent life insurance cash value. Permanent life insurance cash value. We have two types of permanent life insurance. We have the whole life insurance and we have the universal life insurance. Depending on your situations, depending on your risk tolerance, depending on your situations, we're going to assess you to recommend the one that fits your financial goals. So, permanent life insurance with investment component. Okay. So, life insurance, let me be very, very clear here. Life insurance is not an investment. Okay. But there are some aspects of that insurance that have some form of cash value. Okay. Because some people actually misinterpret life insurance to be an investment. No, life insurance is not an investment. Okay, it's a powerful tool for protection, but if it is designed properly, it can be a wealth building tools for medical professionals because it has some component of cash value. Cash value growth tax-free within limits. Okay, and borrowing against policy without tax implication. Okay, now once the money grows, you can continue to borrow from the policy cash value without paying taxes. And another powerful strategies is what we call immediate finance arrangement, advanced strategies for corporations. I've talked about this many times. I don't want to start explaining this one again, but I'm just telling you that the two type of life insurance can actually use we can also use it for IFA, immediate finance arrangement. But the goal here is that you want to make sure you balance your portfolio, right? You have registered retirement saving plan, you have tax-free savings account, you have individual pension plan, plus you also have permanent life insurance, right? Because why? Every of those vehicles have different functions they are performing in wealth building and to accelerate your wealth. All right, medical professionals, your case is extremely peculiar, and you need to look for professionals that can help you to put up strategies to accelerate wealth. Okay, corporate class mutual funds. Everybody type mutual funds, mutual funds, mutual fund. Tax efficient investment structures that allow for tax deferral, tax-free switching between funds, and improved tax after tax returns when registered accounts are fully utilized. So in this case, so we have some registered account. Okay, this are this is another way to build wealth, right? When registered accounts are maxed, okay, you can actually use the mutual funds. Okay, it's deferred taxation until withdrawal. So when you take the money out of it, that's when you're going to pay taxes. Like mutual funds, like maybe like stocks, bonds, and all of that. Those are the examples of mutual funds. Okay, now in this case, you anytime you withdraw money from it, okay, uh you pay taxes. That is just the difference between these and other type of investment vehicles that you have. For example, some I think I've done a presentation on tax now, tax later, or no tax at all, right? This is tax now type of investment. Anytime you put money there, you withdraw the money, you pay the taxes. Funds Switching between funds tax free. So rebalance without triggering tax gain. So you can actually switch funds when you are auditing your finances. Like every year you audit your finance, you look at it, right? That is what we call rebalancing, right? So you want to make sure that all your asset portfolios are in line with your investment and financial goals. That's just the simples of rebalancing, right? You look at it, okay, this one does not really fit my financial goals anymore. How can we restructure it to fit my need? Because the advisor that designed it is not for the advisor, it's for you as a medical professional. So you need to understand how to rebalance at every point. And like I said, it is not your duty to rebalance. Your financial advisor, your insurance advisors, your tax plan, your financial planner will help you to do that. Better after tax returns. So more money stays invested and growing. Now, in this case, you have enough money for investment and growth. Registered education saving plan for children. Every type RESP. RESP. I have this for my kid, right? So registered education saving plan is a tax advantage education saving plan with government grants that grow tax free until your child's need it for higher education. So a lot of us, I know a lot of Canadians have this type of investment vehicles, and it is for children, right? So go 20% government grant, like I when I wanted to start this, right, CRA just sent a letter to me that I have a $500 grant that I should go and open RESP for my child, right? So if you don't know how to set it up, you can book a call with me. I'm going to show you how to do that. Okay, tax free good, no tax on investment returns while invested, right? So the return on investment, right, whatever you put there also grow tax free, right? So the money that grows on that investment, you don't pay tax on it. That's just the reason. Long time horizon, stay early for maximum compound. Start early for maximum compounding. So the earlier you start, the easier for you to compound these strategies tax free, right? So because if you have a child, once you give out a child, please set it up for them. So whatever you can put there, right? We are getting child benefit, especially for those of us that are getting child benefit. Whatever you are getting from there, that money is not actually for you, it's for your children education. So invest it in a right vehicle so that when the child is about to go to university or college, he has enough money to spend. That's the essence of the registered education saving plans. Education funding, withdrawals tax in child's lower bracket. So if your child is lower tax bracket, it might be taxed. It all depends on the way, the tax, the withdrawal bracket of that child, right? Leverage your corporation. Okay, leverage your corporation. Pay yourself optimally. Now, we have dividend, we have salary based on your needs. Now, let me explain this a little bit, right? So when you have a corporation, you can decide it to either do salary or you do dividend. But smart professionals do both, right? Dividends means that you go to your corporation, you pull out money. So as at the time you are pulling the money, you are pulling money that you have not paid the tax. So you are pulling before tax dollars. You are spending before tax dollars, right? So at the end of the year, you're going to pay tax. So what smart doctor does that as you are pulling out the money, your accountant will be calculating the dividend for you. Like they'll be calculating the funds at the end of the day. And if you don't pay tax immediately, the money will be warehoused in what we call shareholders funds. So, but the goal here is that the money is still going to be taxed at the end of the day, because it's not, you have to pay the tax. It's an income that you need to make sure that you remit whatever tax that is accrued. Now, you might also do salary. Salary means that every month you pay yourself, right? Once you pay yourself, it's a strategy to, to manage taxes. Because if you don't do that, at the end of the year, you might end up paying so much taxes. So at least it's better. Whatever you take out every month, okay, you will pay the taxes immediately. You remit that to CRA. So at the end of the year, let's say, for example, you're supposed to pay like 20, $30,000 and you are doing salary. Probably at the end of the year, you're paid from the salary you are taking, they are deducting taxes, and you pay maybe half of that. Let's say you pay $15,000. So what remains is just $15,000. It will not give you much stress to pay the taxes. So as you are making as you're taking the salary, make sure your accountant remits the tax portion and the pension to CRA, so that it doesn't become a problem. Retain corporate earnings. So invest excess within corporation. So like I said earlier, if you are if you have a corporation, okay, and you make profit at the end of the year, whatever profit you make, you need to sit down and ask yourself, how do I multiply this money? How do I invest this money, especially without paying crazy taxes? Okay, how to do that? We are going to guide you on how you can invest your retained earnings that will not trigger corporate taxes. I mean, like I met a doctor who has a chunk of money in his corporation. Okay. And I do ask him, okay, what are you doing with this money? And his answer was, if I spend this money, I'm going to pay a lot of taxes. And I laughed and I said, look, there is a way out. And I don't blame him, because why? He's not an accountant. And the reason, and his accountant is not accountant, your accountant will not tell you that this is how you can build wealth. You need to work with a advisors that will guide you on how to build wealth. What I did for him is to make sure that we pull that money into a holding company. Okay, I asked him to go and open a holding company, and he opened a holding company, and we moved the money to the holding company. We set up a strategies on the holding company in such a way that that money it does not pay a single tax on that money. Imagine that. It was like, oh, I've never seen this type of strategies before, right? If you don't know, you don't know, right? Everybody type corporations. So if you have a lot of money sitting down in your retained earnings and you don't know how to go about it, you don't know how to invest it, please contact me. I have answer to that. I can guide you on what you need to do, how to put that money to work, and how to multiply that money without paying a single tax. Okay. Corporate owned insurance, tax advantage growth, and successions. Now, I'm going to explain this, right? There are two ways I've just talked about here. We have the retained earnings, and we have corporate life insurance set up on the corporation. Many professionals used to ask me, how do I set up a corporate life insurance that will help me to maximize my taxes for tax optimization? This is the answer. Let me explain this, right? Now, by its nature, corporations enjoy lower tax bracket. If you agree, say I agree. right? Corporations enjoy lower tax bracket. Let's say, for example, as a medical professionals, you must have a need for a life insurance. Let's say, for example, you set up $2 million of death benefit and you are paying, let's say, $5,000 monthly contribution to that life insurance of $2,000 per annum. That's $24,000. Now, because the corporation is the one paying for the insurance, corporation is the owner, corporation is the beneficiary. You, the medical professionals, is in the insured. Okay. At the end of the year, there's what we call add back. All right. Your accountant will add back all whatever money you pull out from the corporations that need to be taxed. So they add back the premium, which is $24,000, multiplied by 12%. You can imagine that, right? So that is a powerful strategy to reduce taxes from your corporation. I'm going to repeat that. Okay. You set up a life insurance on your corporation. Corporation is the payer. Corporation is the owner. Corporation is the beneficiary because the money must go to the capital dividend account, right? But because the corporation is the one paying for the premium, all right, they're going to tax the premium at the corporation standpoint taxes. Like you are going to pay probably between 12 to 13%. But if you decided to take dividend, right, or you pull the money out for whatever reasons, you pay salary, okay, you are paying between 39 to 40% on taxes. So which one is better for you, to pay 12% or pay 39%? So at the end of the year, you realize that you save so much money by putting the money in a corporate life insurance as opposed to the dividend. Get me right here, right? I am not saying that you should not do dividend. Okay, do a little bit of dividend, do a little bit of salary, start, open RRSP, open TFSA, do a little bit of independent IPP, all right, and also do RESP for your children, plus open up a corporate life insurance for tax optimization. Now, it's a powerful strategy to build wealth. Because why? Because if you don't save that money in a corporate life insurance, and the money flow to the retained earnings, and you reinvest the retained earnings, if you don't use the strategy that I just explained to you now, let's say you now reinvest that retained earning on different investments. Once you make more than $50,000 on that retained earning, you lose what you call small business deductions, SBD, and you start paying more than 50% on taxes. If you don't know, you don't know. If you get value for this amazing presentation, please type value. So I want you to type value. Value. Just type value. If you get value for this presentation, please type value. Type value. Value. Now, corporate investment portfolio, passive income planning strategies. Okay, now this will give me an opportunity to explain the passive income strategies, right? Like the doctor that I mentioned the other time, like he has a lot of money in his retained earnings and is afraid of investing this money. Okay. And I met him. I said, hey, look, what is this money sitting at? Like a lot of people have more than $500,000, $1 million, $2 million in their retained earnings, and they're afraid to invest that money, right? Let me just explain in a very layman language. Let's say, for example, you have $500,000 in your retained earning, and you want to go into let's say you want to go into commercial real estate. Okay, what smart doctor do, what smart business owner do, is to have a holding company. So because the holding company does not have any operation, so what the holding company does is to reinvest the profit from the corporation. So they pull money from the corporations, put it in the holding company. From the holding companies, you can go into commercial real estate. So the money will continue to grow for you while you continue to reinvest the money into something different. And it saves you a lot of hassle from taxes. So it's just about understand how money works. Guys, they don't teach money in school, right? They don't teach money in the university. But and that's why people are really struggling to build wealth. You cannot do it on your own. If you think that because I've done, maybe when I was in university, like do a little bit of finance, and because of that, I know how to buy stocks, I know how to buy the investment and all of that, you might not really, your money, you might lose money. Let the professionals do it for you. And before the professional do it for you, make sure you are dealing with experienced professionals in your area. Not all financial stroke insurance advisors are trained to handle your peculiar situations, to handle your specific situations, right? So we have different niche. So before they sit down with you to start doing your financial analysis, to start advising you, ask them, do you specialize in my area? Because if they don't know what your situations is, what you are going through, your peculiar financial situations, they may not be able to advise you rightly. If you are getting value, please type I'm getting value. Type I'm getting value. Okay. Now let's go to donate strategically. Donate strategically. Everybody type donate. Donate. Tax benefits while supporting value causes. There are so many people out there, they have opportunity to, like, they are philanthropists. Okay, they want to give to the needies, they want to support, you know, association, organizations out there in order to champion their cause. Some people just believe in some certain causes and they want to support them. To do that, all right, they go into donation, and it's a very powerful vehicle to save on taxes. Eliminate capital gains while receiving full credit up to 50% plus savings. So if you are doing this, all right, um you are eliminating some gains, because the money that's supposed to go to the capital gains will go to the donations, and you get a tax receipt for that. It's a way to, like, lowering your tax bracket. Corporate donations lower corporation taxes through strategic giving. Like I said, now if you are doing this through corporations, it will actually reduce your tax liability to a BRS minimum. Now, the more you give to the to all these charitable organizations, the more it helps you to reduce money that will go to CRA. After all, it's actually better. Like, for example, if you give tithe to churches, you give tithe to mosque, you donate to mosque, or religious organizations, all these non-profit organizations, all you need to do is to get a receipt, right? CRA accepts that as a way of managing taxes. If you know, say, type it that I know. If you don't know, say I don't know. If you are getting value, please type I'm getting value. I'm getting value. Now, donor advice funds are immediate tax receipt with features distributions control ideal for high incomes years. So, sometimes you can use it for income distributions. It's a powerful way to also, mitigate taxes. You can use it for, future distributions and charitable insurance. You can set up a life insurance, create tax benefit with charity as beneficiary. You can set up a life insurance, and you name your charitable organizations, your charitable, anything you believe, maybe you support a cause. Like, we have some people, like, maybe when they're in universities, they don't really have enough money, and maybe some organizations sponsor them and they want to give back, right? I remember when I came to this country as a refugee, right? Salvation Army is one of the organizations that I really want to give back. Because why? They give us clothes, they give us food, they give us so many things. So these are the things that a lot of us are really, really passionate about. This type of arrangement. We want to give back to the charity. We want to make sure that at least I want to pay them back, right? So these are the ways to, and all those things, if I give them and I get the receipt, I'm going to use it to file my tax. It's a powerful way to save on tax. You can save up to 54% in taxes while supporting that causes. causes that matter to you. I mean, 54% is very, very huge. So if you have not been doing this, please start doing this. And you don't really need to go and give the money. You can set up a life insurance and name them as the beneficiary. Whatever you put there is going to be tax deductible. Okay, because why? It is it's a charity. Okay, let's look at the case study of Dr. Sarah. Dr. Sarah, high income physician, implementing multiple tax advantage strategies to achieve significant annual tax savings and build substantial tax rate. So let's Dr. Sarah is making $400,000 in income. So he set up TFSA, RRSP, corporate policies, and RESP. Annual tax savings is $60,000. After 25 years, excuse me, Dr. Sarah was able to build $3.2 million in tax-free real estate. Wow. Say, little by little means a lot. You don't need to be dropping a lot of money. Even if it is $500 as a medical professional, right? Even if it's $1,000 on a monthly basis, set it aside on this investment vehicle. It's really going to give you a lot of values at the end of the day. And don't procrastinate. Don't delay savings. Don't delay retirement. It's important to start planning as early as possible. It is not how much you make, but how much you save. Mistakes to avoid. Everybody type mistakes to avoid. Mistakes to avoid. Over contribution penalty. 1% monthly tax on excess amount. So TFSA, RRSP, okay, there is a maximum you can put into this vehicle. Be guided. Make sure you work with your financial professionals to guide you on how much you can put there. The more, if you exceed the contribution limit, you are going to be penalized. Don't do that. Low yield TFSA usage, wasting tax-free growth potentials. Make sure you ask, where are you saving my money? What is the rate of returns on the money I'm putting aside? Ask questions. At least have a little bit of understanding about all these investment vehicles is very, very important in order for you to build wealth, right? Uncoordinated planning, missing integrations opportunity. Are you doing financial auditing every year of your finance? Are you auditing your finance? Are you really looking into your finance? All right. Are you rebalancing? What type of asset classifications do you have? All right. What does it really fit your financial objective? Does it really meet your financial goals? These are the questions you need to ask yourself. It's very, very important. Action plan. Everybody type action plan. Action plan. Action plan. Number one, fund your TFSA and RRXP. Maximize tax advantage account first. That's the first strategies. Okay, maximize it first. Make sure you utilize your room. Review corporate strategies. Optimize investment approach. Look at other investment approach like mutual funds, like individual pension plan, and other types of strategies. Now, insurance consultation, explore permanent life insurance options. So don't leave it up to different investment approach. Of course, look at the permanent life insurance option as well. Diversified your asset classifications. Okay, build personalized roadmap. Create comprehensive tax-free wealth plan. Now, wealth building is a personalized strategy. What work for A might not work for B. What work for B might not work for C. Understand your risk tolerance, understand your risk appetite, understand your financial goals and objective is very key when you are building wealth. Okay, so don't copy, right? Sit down with your advisors and ask questions. Okay, if somebody asks you to come and do something, the first question you need to ask yourself is, how does this really impact my life, my wealth? Does it really help me in building wealth? is very important. Now, thank you so much for listening to this amazing presentation. So I'm going to quickly uh, go back and add my QR code. If you get value, please type I'm getting value. I'm getting value. I'm getting value. Thank you so much for listening. So if you need a personalized consultation for your wealth building, if you are looking to build wealth, if you're a financial professional or you're a business owner and you are looking to implement any type of these strategies, or you want to specialize in my niche, you can scan the QR code and book free consultation call with me to walk you through on how you can start your niche, how you can also start helping medical professionals. And if you know any medical professionals are looking to build wealth, you can just screenshot this QR code and send it to them to book a personalized, free section with me to walk them through different investment strategies on how to start building their wealth. Once again, I want to say thank you for joining today. If you have any question, please, I want you to please put it on the chat box. But before we go, I want you to please let it be engaging. If you get values, once again, I want you to please type value. Type value. It is very key in this part of the world. Information is very key. If you don't have enough information, if you don't have the right information, you'll be leaving money on the table, to CRA. Okay, you'll be leaving money on the table. So and it's not a good thing. Like I always feel bad anytime I made high income earners and I'm making so much money and they are paying so much money. I met an individuals late last years, and I look at the kind of tax he's paying, and I was like, I'm not happy about it at all. And that's why I take it upon myself that I'm going to be doing this every week to open, professionals, medical professionals, and business owners on how they can actually save a lot of money from taxes. Any question? If you have any question, please put it on the chat so that we can look at it together. Any question? Any question, please? Once again, I want to thank everyone that has joined today. I want to really appreciate your engaging. You are so I really appreciate that. We're all of us, we are still learning. We're still educating ourselves. So I'm also still learning. Okay, I have my colleagues here. I really want to thank you so much for joining. But if you have any question, like I said, please reach out to me. I'll be more than happy to answer your questions. Once again, thank you for joining. See you next week. Bye for now.